Hello, I'm Kevin, and I thank you for joining us for the agenda I'm sharing on the screen, starting with a few quick program notes. We have a fireside chat to begin our discussion, followed by a short contextual presentation, leading into a panel discussion shown here at 11:40 Eastern, and we'll be wrapping up by 12:30. And also, please note that the following presentation is for informational purposes only. None of the information shared or the opinions given are to be construed as an offer to buy or sell a security. And if you have any questions for the speakers during the program, please use the Q&A feature. We'll answer as many questions as we can during this webinar, and we will follow up afterward to answer any remaining questions that you have where conversations are appropriate. And always looking forward to connecting with the community that we're building here. So thank you for joining. And these and more details on the agenda and the speakers, including biographies, are available on our website at privatemarketsinsider.com. And hello, everyone. I'm Kevin McCaffrey, and it's September 1st. Summer is going to come to an end here, and I'm glad you didn't miss the bus as we go back to school on private equity with LPs and GPs that will be making our agenda and exploration of all things private equity. And thank you for joining us, whether it's from the beach or already back in the office. I hope you made the time this summer to spend with family and friends, time to ponder what's most important as COVID, market swings, climate, geopolitics, and related issues remind us how fragile our world can be. Summer can be an important time to reflect, to determine your direction for the fall and beyond. If we had all day, I'd love to dig into the inner thoughts and processes of each of our guests, but in the interest of time, one thing I've done to help get acquainted is ask them each to dig into their thinking by providing a quote that they find indicative of their philosophy or meaningful to them or even just amusing. So I'm as interested as you to see what we get. And for my part, I recall heading back to school at Lehigh University, and one of my engineering professors began a class with a quote that stuck with me. Education is not the learning of facts, but the training of the mind to think. Albert Einstein. So with that, let's dig into lessons on how our speakers think, a combination of institutional investors, family offices, fund managers, and other key insiders in the private markets. And starting off, actually, I'd like to introduce Jonathan LaCrosse, who has blended a number of these different roles through his career. Jonathan is now managing partner of Gabriel Horn Capital, and he has a unique perspective based on a combination of roles as an LP, a GP, as a placement agent. He put over $4 billion to work as an LP with Robert Wood Johnson Foundation and CalPERS. He launched the Centinela Capital platform and focused on investing in emerging managers. Then he found creative ways to bring LPs and GPs together as he launched Trusted Insight as a media and screening platform. Shortly after that, he became a placement agent, and he's raised over $4.5 billion working in that capacity before partnering with Brett Nelson to create what is now Gabriel Horn Capital earlier this year. And the team overall has invested more than $12 billion as LPs, raised more than $12.7 billion as placement agents. And I'm pleased to work with them as Jonathan and the team leverage his experience and expand his capacity to help a mix of private equity, growth equity, venture capital, and independent sponsor clients. And with that, I'll remind the audience to write in any questions using the Q&A feature. And please, Jonathan, take it away.
Well, thank you, Kevin. Appreciate those kind words. And it's a pleasure to be here with you today. Can't believe it's September already. So going on the theme of quotes, having been a LP when I was at the Robert Wood Johnson, we invested in many of the Oak Tree funds, and I used to read Howard Marks quite a bit. And one of his quotes that seems relevant for the last couple of years, prices are too high is far from synonymous with the next move will be downward. Things can be overpriced and stay that way for a long time or become far more so. So that's from his quote from The Most Important Thing Illuminated, uncommon sense for the thoughtful investor. So anyway, I am joined here today to do a fireside chat with Matt Curtolo from MetLife Investments. And we're going to be hearing from an expert LP on his perspectives on what's going on in the private equity world. So without further ado, let me give you a little overview of who Matt is. Matt is a director at MetLife and is responsible for the oversight and management of the firm's domestic alternatives portfolio. Prior to joining MetLife, Mr. Curtolo served as head of private equity at Curtolo Callahan, an outsourced chief investment officer. There, Matt led all private equity activities and was a member of the firm's investment policy and strategy committees. And prior to joining Curtolo Callahan, Matt worked at Hamilton Lane in a variety of capacities in client service as well as investment roles. And he holds a BS in finance from DeSales University and is a CAIA charter holder. So Matt, welcome. It's a pleasure to be speaking with you today. Maybe we can kick things off with what's your quote today?
Yeah, thank you, Jonathan, for that introduction, and great to be here this morning. My quote is it's not from anyone. It's really evolved from my own investment philosophy. For those, it's the headline on my LinkedIn profile, which I think is interesting, but it's question the paradigm, do it daily, following the crowd is for suckers. So a bit provocative, but I think, when I think about the investment philosophy that I've been developing over the last 2 decades and an asset class that's been evolving, that I think really hits the nail on the head, that you have to continue to press forward and not fall into the trap of following the herd. I think there's a lot you can read about the reversion to the mean in all asset classes, but in particular in an asset class where there is no benchmark or index, really putting yourself out there, looking for what's next, looking for what may be new and different, I think is the core of my own personal investment philosophy, but also as we think about the asset class as a whole.
That's great. We'd love to hear more about how you're a leader from the pack there, as a lot of investors are sheep and follow. So look forward to get going. Let's kick it off with where MetLife is at today as far as meeting in person. I just read today in the Wall Street Journal that Google has delayed their team going back to the office until January 10th. Just talked to an LP yesterday, another big insurance company. They've delayed going back to the office until January. Are you? Looks like you're working from home. When are you guys going back to the office? And are you meeting with managers today, or is everything still being done by video?
Yeah, I think, Jonathan, where we are today is back to the office is a bit of a moving target. I think we had expectations, certainly in a week, that we would be back in the office. I think most people had around Labor Day as a target date for returning to the office in some capacity. I think most firms have realized some benefits of the remote work, one of which I'm a big advocate for. But in terms of getting back to the office, we've pushed that back now into October. And again, moving target, we'll see what the prevailing sort of conditions are, and we'll see what happens from there. And all meetings, and given that, have still been virtual. I would say we've found a lot of value in this. Given that it's the only medium that we've had for the last almost 18 months, learning how to do Zoom meetings has been a little bit of an education for a lot of us. But I think it's allowed us a little bit more flexibility and the opportunity to potentially meet with and speak with more managers than we would have in the pre-COVID time period, where everything was driven by more in-person meetings, and coordinating schedules and calendars and things like that for all of us, I can imagine is a challenge. But just having the opportunity, a bit of a lower impact meeting in terms of a Zoom meeting. So we're still going forward with that now. And I do think it'll be a critical part of what we do going forward.
That's helpful. Well, maybe you could take a step back, give us an overview of the MetLife investment program and the allocation and where privates sit in all of that. And then we can go into a deeper dive into the private equity portfolio and what you're seeking.
Sure.
Great.
Sure. Yeah. So the MetLife program is really focused investing for the insurance company and its affiliates, which is a very large pool of capital. So you can imagine, as a life insurer, a good percentage or the largest percentage of those assets are allocated to more stable and fixed income type assets, both in fixed income and real estate. Where me and my team are working is within alternatives, and that covers really all private equity asset classes. So we're investing in primarily buyout, venture capital, and growth equity. We have a bucket for opportunistic and special situations, private equity oriented strategies. We'll also do some opportunistic credit in there. And we do that on a global basis as well. So we have a team of 4 based in London and 8 of us headquartered in New Jersey who are covering sort of all asset classes globally. I would say, interestingly enough, we're not investing in traditional private credit or private real estate, given the construct of the insurance company. Now, certainly on an opportunistic basis, we'll look in those areas, but the core, I would say, sub-strategies within private equity is where we're spending our time. And on an annual basis, really through a bottoms-up exercise based on business line by business line, the insurance company comes up with an equity need, which is what we're responsible for deploying into mostly primary funds, but increasingly co-investments and secondary positions. So that can range given the year and the needs of the insurance company, but safe to say we're quite a sizable investor across these strategies and across the globe.
Oh, that's great. Well, I read Preqin this morning, and they said that the number of buyout deals completed in the first half of 21 shows it's well on its way to beating 20. And the VC aggregate value of deals completed in the first half has already surpassed 2020 at $153 billion. And Preqin sees further acceleration across privates through 2025. So given what you had just mentioned about where you invest in, what specific areas are you looking to invest in, A, for the remainder of this year, and then as you look out into 2022?
Sure. And, I think we think about it on a more of a longer term period. So certainly we build our strategic plan for, call it, 3 to 5 years in terms of strategies we may want exposure to, in terms of areas of the market that we're underexposed, manager types, manager sizes. So we'll go through a bit more of a strategic planning session to think about where we want to be in the long term. Because as you know, being tactical in this asset class is not easy. We're not traders. We're not buyers and sellers. We are thinking about this over a long duration. So what we're doing for the balance of the year is really an accumulation of what we've been thinking about for the last 2-3 years. And that will be a continuation of investing in really high quality managers across this space. It's easy to say. I think something we can talk about in the future is really defining what a high quality manager is. But within buyouts, I think a clear focus on groups that are operating in the less efficient mid-market and lower mid-market. That's an area that I think we have an opportunity to generate value, even to the points you just made, where there is a lot of activity, where prices are quite high. We can find perhaps a little bit more opportunity for value creation in those lower middle market spaces. And I think venture capital is a place we've been very active. I think if you look at us relative to peers in the insurance space, we're one of the more active venture capital investors. That's driven a lot by a corporate view on the value and the virtue of technology. I think we're seeing in spades now, given all of the enablement that we've had from technology across all verticals. But I think that is where we really focus in on managers that have great access, managers, again, that are looking at perhaps particular niches within venture capital and growth equity, focusing on technology that can continue to drive both secular and sort of step function trends in the markets. And I would say a lot of those are increasingly global. I think venture capital, you can think about 10 years ago, was much more of a domestic play, but now we're thinking about this both in Europe and Asia as opportunities for us to continue to get allocation.
That's helpful. And just to put a little bit more definition around it, you say lower middle market, but given that you guys probably have to put out significant bite sizes, what do you define as lower middle market from a fund size, from a deal size? And then how do you deploy enough money in venture capital? Is there a certain fund size that you're seeking there as well?
Sure. Yeah. So on the lower middle market side, I think fund size is tough to figure out what exactly that number is. But really, when you look at deal size, sort of sub $20, $25 million in EBITDA businesses tend to fall in that lower mid market. And that could be a $250 to $500 million fund or $1.5 billion fund. So I think we're flexible around that. We don't operate with a bucket to fill. It's really thinking about the opportunity set and where they're targeting. So we're looking more at the fundamentals of the businesses that the managers are acquiring. And then on the venture side, there's an interesting opportunity here, I would say broadly, from an emerging manager's perspective. So where you have very seasoned professionals who are going out and starting their own funds and firms that have tended to be a bit smaller. So we give ourselves a bit more latitude on the venture side in terms of fund size. It tends to be allocations that may be less than our sort of standard bite size, but in terms of access, where it's critical to be a first mover in some of these situations before access is truly constrained, we're willing to go a little bit smaller and look at funds, call it $100 million or more.
Wow, that's helpful. So PitchBook came out with their quarterly report yesterday, and it was extremely interesting to see that over the last 10 years, the private equity returns have been 14.0%, and over the last 10 years, the venture capital returns have been 14.1%. So for that additional risk that you're taking in venture, you're not getting a whole lot as far as additional returns. So what are the keys for you to finding top decile, top quartile returns that either match that or outperform that? And how are you de-risking, when you're looking at venture that has had similar returns to the private equity?
Yeah, I think that's the million or multi-billion dollar question in terms of trying to find managers. Because again, back to the original point of you can't just buy the private equity markets. So even with those numbers you just cited, I don't think there's an LP out there that's generating that type of return in the same way. It's all done through managers. So I think that's something to remain critical. And the question you just asked is the right one for all of us to kind of figure out. I always find it interesting from a relative basis. Most of these managers, none of them know what top quartile will be for their vintage. So going in blind and saying we're going to be a top quartile or top decile manager is a bit unknown. It goes back to the ability to benchmark and really try to find groups that are going to outperform peers in what is truly an absolute return asset class. So I keep that in my back pocket just to remember when I'm assessing managers. It's really about, can they generate an absolute return that's going to fit for our institution? So thinking about what the level of return, thinking about risk. But I think a big part of that is, we try to go into process and people. You think about due diligence, the 4 Ps, portfolio performance are important, but process and people, I think, are the keys here, because it's about sustainability, it's about being systematic, and there's an element of durability there. So we certainly don't want to we don't want to look for a manager who continues to shapeshift and look for different opportunities and change their stripes to the flavor of the market. So we want to find a group that we believe has a systematic and sustainable process, and with people that we can attribute that process to. So I'd say that that's the biggest part of our due diligence process. My own at historical firms, but also today at MetLife, where we're applying a very heavy focus around people and process. And I think the value of reps. I've been doing this in varying capacities for about 18 years. So thinking about pattern recognition, who's doing what today versus 10 years ago, how has the entire landscape changed? All of those things go into the memory bank. I think as we think about developing teams, as we think about finding funds, all of these come together where you're doing the best you can to find those managers that have the qualities that can achieve the level of return that's going to be acceptable for you as the LP. I think of the quartile and decile ranking as an output rather than an input. So we'll know in 5 to 10 years how that all does plan out. So I think it gets to, a broader point in terms of just what understanding the goals of your institution and mapping that to the opportunity set available. Your question about venture capital, I think there it's even more so focused on range of outcomes. So when we look at particularly an early stage venture capital, we know the risk going in there in terms of loss ratios, in terms of potential downside, but we also want to see a historical ability to capture upside. And that's really, I think, an important piece of the venture capital landscape. It's driven by, it's very much a power law asset class where you just think about those outlier returns that are going to drive not just an individual manager or fund, but almost the entire industry as a whole. It's 24 companies every few years that really do drive the vast majority of those outcomes.
Yeah, it really is. So in your 18 years of experience working for these prestigious firms that we listed before, what's one key takeaway that has evolved, whether it be, the 4 Ps that you mentioned, or the performance, specialization, strategy, terms, teams that you really have seen and you look for today?
Sure. Yeah, it's amazing to think about when I sort of started my career in the early 2000s. I don't want to call it a cottage industry, but private equity was really still trying to find its footing in terms of acceptability across, asset allocators, finding places in asset allocations, really understanding what it was. So the pure evolution, when you look from then to now, in terms of the number of strategies, the number of funds, and the amount of capital, really just tells you something about, I think, the evolution of the industry as a whole. And I think it's, when I look back, the sustainability of performance across cycles and relative to alternatives, to other investable alternatives, has really been, I wouldn't say eye-opening, but something that's continued to surprise me. Everyone continues to say the music will stop at some point, and look for ways to poke holes in the industry. You have a lot of research, really opposition type research out there that say the public markets or other areas of the investable universe will outperform. Look at things like dry powder, point to a lot of statistics. Yes, I think there'll be some modulation of that over time, but really from an asset class perspective, its ability to evolve and sustain performance, even in different times, as it's grown exponentially, I think has been one of my key takeaways, and it goes back to my quote, is just continuing to follow and look where the industry continues to push out to, make sure you're ahead of or with those trends.
That's great. Thank you, Matt. So going back to your quote of not following the crowd. So how do you find differentiated managers, differentiated strategies? Do you guys do top-down analysis, or is it very opportunistic and you meet with somebody? Yeah, that's what we're seeking. What is it that helps differentiate MetLife in your program?
Sure. Yeah, I think differentiation, you almost have to define that first. Are you looking for something differentiated than other asset classes? Are you looking for something within the private markets that's different? Are you looking within a sub-strategy for differentiated pieces? So we deconstruct that a little bit. I would say at the most foundational level, when you're looking at individual managers, we ask the question, as simple, one word, why? And why does the manager exist? What is their motivation? So it all ties back to that. And we're really looking for an edge, oftentimes intangible, but an edge that's going to separate them from their peers. It's oftentimes not something we can do a lot of background work or due diligence around, but it is something that I think is where we find differentiation in the market. It almost goes without saying that, finding an esoteric subsector is going to be differentiated relative to some more mainstream areas, but that may not be the differentiation that you're looking for. It may be someone who has a particular angle around sourcing in a region with a methodology, with proprietary software. I think it does too go back to the reps and knowing what a traditional middle market buyout fund, for example, what that pitch is going to sound like. And the light does sometimes go off and you say, wow, this is really different. And it may be different for the sake of being different, but it may also be something that can create a sustainable edge. That is what we're looking for when we find these types of managers.
Yeah, we work with managers and independent sponsors that have a lot of experience, work with funds between 100 million and sometimes up to $1 billion in fund size. And we think, they all have some kind of edge to them, or else we probably wouldn't take them on as a client. But just curious, sometimes we work with the fund ones and they seem to have, particular edge and have produced excellent returns. So do you invest with emerging managers? And then, what's the bar like for you guys investing there, if so? And what really needs to stand out? Because I'm sure that there's some emerging managers, independent sponsors on the line today. So maybe you can touch on that. And what's the criteria you look for in the bar?
Yeah, so I think most of the market now, you have a lot of really experienced seasoned managers. And Jonathan, from your own experience, as a large LP, you're going to tend to re-up with the managers So already the pool for new managers is small. And then you think about managers that you don't know, that you've met with over the years, that have a bit more of a history. Oftentimes they fill that bucket of new manager allocation. So it is truly an uphill climb for emerging managers. There are a lot of great LPs that have dedicated programs around emerging managers, because I would argue it's one of the more interesting opportunities in the market today because of that dynamic of very experienced folks. It's a bit of a misnomer that they're a fund one because they have years of experience and attribution that you can point to. But getting in front of the right groups and finding that path where there's LPs with dedicated capital, I think is really, it's a smart approach to sort of figure out the highest and best use of your fundraising time for emerging managers looking to raise capital. From our own perspective, it's a time and labor intensive process. So you have to think about what you're really looking for. What we've developed in our emerging manager program today is really a primary focus on bringing in more diversity into our portfolio. So having a particular screen also helps, I would say, reduce that upfront screening time, because we really know what we're targeting, and those criteria upfront can give us a little bit more of an opportunity to spend more time with those managers, because I think the number of groups that are out there now from an emerging manager perspective, from a fund one, fund two, is very high. And so without necessarily having that path to an LP with dedicated resources and capital there, it's going to be a challenge to kind of break through into a group like ours, where I think we fundamentally believe in the opportunity. I certainly personally believe in that opportunity, but resources and allocation tend to gravitate in a different direction unless you're thoughtful and deliberate about how you're going to approach that.
That's excellent perspective. Oh, Kevin has popped on. I think we've hit our time limit. I don't know if you have any other closing thoughts, Matt, but this has been excellent to get your insights here in this little chat. Is there anything that you want to close with today?
No, Jonathan, just very grateful for the opportunity to speak with everybody today. And I think right now we're experiencing a lot of interesting times, a lot of things that we haven't in a long period of time. And I think that makes us, pushes us to be more thoughtful and stronger as both individual investors and an LP community. So I think as we think about ourselves in a leadership role among not only insurance companies, but LPs, we welcome the opportunity to collaborate with other groups who are thinking about the world in perhaps a different way and are questioning that paradigm daily. Thank you.
Thank you very much, Matt. And yes, we're certainly grateful to have you on and to hear your thoughts. And it really is about the people and the process. And we try to bring people together because these discussions need to be fleshed out even more so outside of these webinars, where we can dig into specific topics that are specific to the investments that you're seeking and so on. And with asset prices all moving in one direction, it seems, we're all worried that we may be suckers, speaking to your quote. So trying to figure out how the big boys are doing it is very helpful. And you're a significant player in the market. So thank you very much. And moving on, I would like to now introduce Brandon Richter, Managing Director of Hamilton Robinson Capital Partners. And here's one of the people that's providing some of those solutions that Matt was kind enough to discuss. And Brandon joined Hamilton Robinson in 2010 and has led transactions, overseen portfolio company investments, and is a member of the investment and management committees. Brandon currently serves as a director of custom engineered wheels, gray matter, Tanknology, and Zone 4. Previously, he served as a director of W Technology, Unifiller, SoundSeal, and Inspire Automation. Prior to joining Hamilton Robinson, he worked in the M&A group at Bank of America Merrill Lynch on deals across a variety of industry verticals. He began his career at Goldman Sachs in the technology division and has received a Bachelor of Science in Electrical and Computer Engineering from Cornell University and his MBA from the Johnson School, also at Cornell. So Brandon, please feel free to share your presentation here on the screen. I see that has come up, and interested to hear what you have for us today. And just as a quick note, he'll also be providing this context as a lead into our panel discussion to come momentarily. So please, Brandon.
Thanks very much, Kevin, and nice to see everyone on the line today. My name is Brandon Richter. I'm a partner at Hamilton Robinson Capital Partners. I've got 3 short slides that I'll walk you through to give you some context on who we are, what we do, and some of our keys to success. I think it might be appropriate given the theme and the topics for the panel to come in just a few minutes. For those of you who don't know us, Hamilton Robinson is a private equity firm focused exclusively on buyouts for smaller industrial and B2B service companies. We take control positions in family and founder-owned companies where we can be the first institutional capital invested in those businesses. Being the first institutional capital means that our deals are on the smaller end of the lower middle market. So our companies typically have EBITDA starting at $3 million and go up to about $10 or $12 million. The firm was founded in 1984, and today we have 5 senior investment partners at the firm. We've acquired 62 businesses over the life of the firm across 5 different funds, and our investment program has been remarkably consistent over time. Industrial and B2B services for us does not mean old world dirty manufacturing businesses, but instead our companies make or deliver services with lots of technical and engineered content and with low capital intensity. As we like to say, they're secular and not cyclical. In that regard, we have a theme-oriented investment strategy, and today we're focused on 3 primary themes. First, in such a labor-constrained economy, we're big believers in companies that provide automation and productivity enhancement. As an example, we closed on a business in March that's an installer of all the automation equipment like robots, conveyors, and lifts that you'd find in a large warehouse for a customer like Amazon or Walmart or Kroger or Home Depot. Those customers, like so many others in America, are struggling to find people to run their warehouses and increasingly are using technology and automation to remove people from the equation. That's a trend, frankly, that many of our existing current portfolio companies grapple with every day, and we see that continuing for some time. So companies that can help address that constraint are very attractive for us from an investment theme point of view. Second, we like technical B2B services that tend to be recession resistant. So whether that means performing regular maintenance service on production assets or manufacturing wear or replacement parts, the critical nature of those revenue streams mean that they'll continue even through tough economic environments. And finally, we love businesses that have a compliance or regulatory tailwind. As an example here, we had great success with a sound control business that was driven by OSHA regulations related to worker safety. So while more regulation can sometimes be frustrating for consumers and operators and investors, we do seek out businesses that will benefit from market growth driven by that increasing regulation. There are a number of factors that contribute to our investment program's success, but I tried to boil it here down to 3 primary attributes. So first, we believe that you have to find the right opportunities. We at Hamilton Robinson are not fans of large, robust auctions run by marquee investment banks. Instead, our strategy is to target smaller business brokers. We sort of refer to them as one-man bands. There's, believe it or not, more than 1,200 of these across the US. And we've got a robust business development strategy and resources designed to stay top of mind with that group. One of these small brokers might only have a Hamilton Robinson deal once every few years, but when they do, we want to be their first call. Second, we want to change the conversation with business owners to something other than price. Focusing on these small brokers and less efficient sale processes give us the ability to showcase what we can offer to owners other than just capital. With the depth of experience, the long track record we've got, the reference list, and a one-size-does-not-fit-all approach, we want to be flexible. We can often position ourselves as the preferred buyer for a management team against others who actually offer high prices. And while you can't steal companies today, we know we ultimately have to pay fair value for businesses. When we can reframe that conversation away from just price, it in turn supports an overall value orientation that we have across the firm. And then finally, probably most importantly, once you get a deal closed, you've got to go and actually start creating value. Our approach to investing centers around creating partnerships with our management teams. Being first institutional capital is a big part of that, but we want to get the culture and alignment right across that management team. And the opportunity to broaden equity ownership beyond just the founder or family owners is a huge part of that. People we have found behave differently when they have a vested interest in the financial outcomes of their behaviors and actions. Most of these family and founder-owned businesses are often run for really different objectives, and they're ripe for process improvement. I'm talking specifically about things like strategic planning, budgeting, incentive compensation, reporting, and technology. So we've got a very well-developed playbook to help these family-owned companies really evolve and develop into really what we call like institutional enterprises. Lean philosophy or lean thinking is our primary toolkit for working on operational improvements. It's a way of thinking about removing waste from any kind of business process, and it works on the manufacturing shop floor, it works in a service organization, and it can work in the back office of a business. For us, lean is not about cutting costs, and we've never cut heads because of it. Instead, we think of lean as an engine to do things better, which ultimately creates competitive differentiation for our companies and our markets, and ultimately is a tool to support organic growth in our businesses. Finally, we underwrite all of our acquisitions, platform acquisitions, to a 3x gross cash on cash target without the benefit of any multiple expansion and without the benefit of any add-on acquisitions. So we're not roll-up guys, and that's not our philosophy, but add-ons that add some sort of strategic capability can really accelerate value creation far beyond the 3x target that we really set for ourselves. So I hope that gives you a flavor for what we do here at Hamilton Robinson and how we've honed a strategy for investing in these smaller businesses literally over a period of decades. If anyone wants additional information, please reach out to me directly. And thanks very much for the time.
Well, thank you very much, Brandon. And I think that ties in really well into even Matt's comments prior regarding an interest in lower mid-market opportunities. Even the larger players are finding that with today's deal environment and high multiples, they need to even have the patience as a larger group like that to invest in this arena. And certainly Hamilton Robinson has been doing this for decades. So there's a commitment to that. You know, you're not a $1 billion fund plus, and it shows that you're willing to roll up your sleeves and get in there with these businesses where you've developed expertise over a long time. So I think, you know, these are the types of things that we hear all the time, that people are looking for a solid team and a strategy that's been developed over time. So anyway, with that, I'll be interested to hear how you tie that into a further discussion around investing for peak performance and private equity, along with the other guests. And we're bringing them on as speakers now, and feel free to draw out any information on them, including the quotes and their background as we delve into this panel. Thank you.
And thanks again, Kevin. So for the audience, the theme of our panel here is investing for peak performance in private equity. And I'm fortunate to be joined by three veterans of investment that bring very different perspectives to this conversation. Gijs van Thiel from 747 Capital, Paul King from Alta Capital, and David Hartberg from Calibrium. I'll start and kick this off by my quote. You heard a little bit of my background from Kevin a few minutes ago. My quote is from the late, great Yogi Berra, and that is, "The future ain't what it used to be." And I think it's apropos for the environment that we find ourselves in today. It seems as though there's something new every day that we're grappling with, we're working around, we're anticipating and trying to react to. And it's keeping us all on our toes, and I think it's sort of just part and parcel for the world we live in today. But I'm going to ask each of the panelists to introduce themselves and tell us a little bit about their firms. And maybe, Gijs, I just start with you. Give a little introduction, maybe your quote, and a little bit of insight on your keys to finding and identifying top quartile or top decile managers as an LP.
Sure. Thank you, Brandon, and good afternoon to everybody, or close to good afternoon to everybody. Happy to be here today and be part of this panel. My name is Gijs van Thiel. I'm a managing partner at 747 Capital. We're a private equity firm based in New York City, where a team of 6 investment professionals is busy every day trying to find good private equity buyout teams in what we title to be the small cap buyout market. And we define that market really in 2 broad strokes. The first one is fund size. We like to invest with managers raising funds sub 350 million. And the reality is it's the average funds we invest in are roughly around 150 to 175 million, so smaller funds. And the second one is the underlying enterprises they invest in. And we're very focused on buyout teams that buy companies with an enterprise value sub 50 million or around 50 million maximum. And we think that that's where these teams can really deliver great performance over time. We're currently investing out of our 7th generation fund. We have about 50 active fund commitments out there in the market, in the small buyout market. And we also have about 60 active co-investments out there. So we are even more active on the co-investment side than making primary investments. And opportunistically, we will look at secondaries, because if you spend as much time as we do in the small buyout market and you speak with as many managers and fundless sponsors and everybody else in this market, from time to time, you're going to run into a great secondary opportunity that you can't resist and you have to make a bid for. So we do that on the side. My quote for today is, there are tons of really good quotes and there are tons of good business quotes that I can identify myself with, but looking at what we just went through in the past 18 months and looking what we're going to go through in the next 18 months, I was reminded by something that Jack Welch said a long time ago, and it was actually, I think it was 2014, when he said, if the rate of change on the outside exceeds the rate of change on the inside, the end is near. And I think we are all very, we should all be very much aware of that there is an enormous amount of change going on around us. And as investors and as LPs, we tend to like what we like, and we tend to be a little bit stuck in that for ourselves. And I think it's really important that we are reminded and we remind ourselves that we need to look around us constantly and figure out where things are moving and why they're moving in a certain way and adjust. And it's not just us as LPs, it's also the GPs we invest with, and in turn, the companies that they buy and invest with or in. You asked me to comment on peak performance or high performance. And I think that's a very relative term to start off with. Every investor and every limited partner thinks and believes that their strategy is set up to create peak performance, but it requires you to define peak performance first, and that definition, I think, is really important. We heard in the first session today, we heard a lot about team and we heard a lot about consistency, and I think that for us, peak return or a consistent above average return with a over time, something that's repeatable and can be done over and over again. I think ultimately the top quartile, as was said before, is defined in the future, but what is defined today is something that is much more interesting, and that is consistency and repeatability. Private equity is a great asset class where past performance can be a clear indicator of future performance, but it requires most of the things to stay the same. And so that's team, that's environment, that's industry, that's expertise. And those are all the things that we focus on. So a lot of the performance we look for comes from teams and from people, because we invest in teams, they in turn invest in management teams, who in turn invest in people that are actually on the shop floors or doing the actual work. And the performance needs to come all the way from the bottom. So a great investment strategy combined with a very strong team is probably the best formula for peak performance.
Speaking to mute. Thanks, Thijs. I really appreciate that. Paul, I'd like to turn to you. Would you mind taking a few minutes to introduce yourself? Tell us a little bit about Alta Capital and how your strategy has or hasn't shifted over the past 18 months, given everything that's happened.
Thanks, Brandon. it has been a couple of interesting years, and it's I think I like you. I started out at Goldman Sachs back in the late '80s, and have gone through a few things, but certainly has been a tough couple of years. So Alta is the investment arm of my family. It controls one of the larger conglomerates in Asia, and so we're exposed to over 40 different funds, and we are in real estate situations, and overall we try to diversify as much as possible without being hopefully too diversified. These days we're trying not to overreact in terms of adjusting our asset allocation too much, but certainly we are doing that, and hopefully we'll get a chance to talk about more specifics of how we are changing some of our strategic and tactical allocations these days. So happy to discuss that a bit more as we continue to talk. My quote, I'm probably going to be a little serious. I think Lord Acton 120 years ago said, "Absolute power corrupts absolutely." And I think these days, you've got everyone from dictators, that some of them we all know, as well as even retail investors have all of a sudden said, "Hey, we are powerful too." And we are seeing a lot of factors, whether it's populism to regulatory to other things that are impacting our investing world, and I think these days it's something that we have to be very careful of, not only for others but ourselves as well, as we feel like we have some influence or power in the marketplace, and we certainly want to be judicious in how we exercise that power. So that would be my quote, and look forward to talking more.
Thanks very much, Paul. There's a lot to process for sure, and it's sage advice from a quote. David Hartford, thanks for joining us. Would you take a few minutes and introduce yourself and tell us a little bit about Calibrium?
Sure. So Calibrium is a Swiss-based independent manager for one family office. It's a multi-billion euro operation, invests across all asset classes. And my role at the moment is senior advisor, after having spent 10 years as a founding partner and then failing in retirement. So for the past 5 years, I've been an advisor, which means I get to cause trouble, but I don't necessarily have to be on the investment committee anymore. So we are, at this point, invested in funds on 6 continents and companies on 5. Those companies are a combination of independent sponsors and co-invest. Like has been, other people have already mentioned, we have a tendency to focus on the lower middle market because we see the inefficiencies there and the opportunity to optimize returns with the lower middle market in particular. But we also will go selectively into the larger funds, different strategies. We will do turnarounds, special sits, and secondaries as well. And my quote is "Nota sa'aton." So in my freshman philosophy class, my prof said, if you ever have an original thought, go back and see how the Greeks said it. So "Nota sa'aton" was Socrates, and it translates to know yourself. And I think we all try to do that, but I think it's also, in our world, it's not just knowing ourselves, but knowing our partners. And that goes all the way down the line. And I think as Paul was mentioning, trying to know who's, and Gijs is, who's down the line and what are they doing. So we need to know ourselves, we need to know our GPs, and then as part of the knowing the GPs is also seeing how they get to know their companies. and how they select those. So, so the second part also, I think, is particularly in the current environment, is to think again, because one of the things that I always love is walking into, or now doing a Zoom with a manager after I've read the materials and I think I know what they do, and then I get surprised by their insight into some element of the operations that I hadn't thought of. And those are the ones that I want to spend more time with and really get to know what is it that sets them apart, that makes them better than the other ones that I've been looking at.
That's
So
interesting.
That's a differentiation has surprised me.
Sure. And David, over the last 18 months, given everything that's going on and given the fact that you've got investments across 6 continents and all of those different strategies, has anything changed for you materially? I mean, know yourself, right? But has yourself changed over the last 18 months, given sort of what's happened?
Well, I think, what has happened is we've done fewer new managers. So historically, we always did, maybe 10% into emerging managers, but not being able to sit down and, be in a social environment with the managers has really held us back on that front. We've done one, what I would say is a truly new manager we hadn't known before. We've done several spin outs, but we already knew those people, and therefore there was already the personal relationship, and so we knew them, they knew us. But I've now that I'm actually able to travel, but my team can't come from Switzerland to the U.S. I've had 3 managers now that I've had personal meetings with recently. But there won't be an investment decision made until I can get somebody to come over from Switzerland and sit down with them. They're just not likely.
Sure. Yeah,
I'm hoping that will change shortly, but it hasn't so far.
Heiss or Paul, do either of you struggle with the logistics of seeing and meeting people in person and how that ties to the investment decision?
Oh, for sure. It's been a very interesting 18 months. If you look back at it, I mean, it's been a big social experiment for a group like us that has been investing with managers for almost 20 years, and all of a sudden we can't meet them and we can't touch the product. It's all 2-dimensional now, and I think that was a big change. I mean, to David's point, we made 2 investments with managers that we had not really met in person. We knew the principles because that's the advantage of being in the market for a long time, but we didn't get over the hurdle with others for that reason. And we probably do about 40% of our allocation is to fund ones, and so we have quite a few emerging or new managers in our program typically, and we have more re-ups at this point. But there's also real positives, and that's, I think, and that's the part that's we tend to overlook because we focus on the what was more difficult and what went wrong. I think one of the really positives is that there was more engagement across the team with every manager we met with, because it's much easier for people to hop on a Zoom call or a video call to hear the story. So as I said, we have 6 investment professionals, and we would meet 2 or 3 of us with a team. And it's not uncommon now that you have 5 or 6 of us on a call, because it's easier and there's no travel involved, and the agendas are just different. So I think that's a positive. The other one is, I think because of that, there is an even broader understanding within the team of all the different strategies that are out there and all the opportunities that present itself. I don't know how we're going to keep that, because we're all excited to go back on the road. We are traveling again. We are meeting in person again. So that's the next challenge we're going to have to overcome, because now everybody wants to be part of every meeting, and that's not going to happen in person. but it's definitely been an interesting learning curve in that sense.
Paul, anything to add from how your process has changed?
Yeah, I mean, not a lot. I mean, we're the same as everyone else. I mean, our team actually complains that there are too many Zoom calls because it is so easy to be on calls with folks, and so they would actually prefer to go back to the days when they looked at the numbers and they made me go do the traveling and meet folks, and certainly after 35 years. I like to think that the old school way of, meeting people in person and walking factories and things is a valuable part of the process. And so I am having to go back out and I think I'm making my first international trip tonight if I can make it out with the hurricane coming in, and we'll see how it goes. But it's starting again. We're traveling and meeting people in person.
Sure. Yeah, it's been a for us at Hamilton Robinson, it's been a sort of an existential question, much like for you guys as LPs meeting managers. The decision for us for portfolio companies, the management team is the most important sort of decision factor. We told ourselves early on in COVID that we would not invest in a company without having met the team in person. And it's lengthened out many of the diligence process because it's become multiple stages where you do Zoom first and you sort of get further along in the process before you go meet a team. But we found that there's really no substitute. If we've never met most of these management teams before, we don't have the benefit of being in sort of the same circles for decades like you do with managers, but it is a key and important part of the decision process. Shifting gears just a little bit, Jonathan said a stat earlier that really resonated with me, and that was that the transaction volume for PE and venture capital for 2021 is going to exceed 2020, which may have been an abnormal year, given we're just at the beginning part of COVID. But I'm just curious for the three of you, how you have seen the level of activity, be that new managers coming to market, be that the underlying deals underneath each of the managers that you're seeing. I'm just curious if there's been an acceleration for 2021 in terms of the level of activity and transaction volume, and what you think might be driving that. Maybe David, do you want to start?
Well, let me take it from two different levels. First of all, from private equity standpoint, since we're down in a lot of our managers are lower middle market, the reports that I'm getting are that there's an awful lot of family-owned businesses that are rushing to get out ASAP before the capital gains tax changes that people are anticipating. So particularly my generation who started companies and has built those companies and their kids now don't want to be running them, are looking to get out as soon as they can, like before 12/31. So at least in the lower middle market private equity managers, they're reporting that they're seeing a 2 or 3 times the number of deals that they're used to seeing. That doesn't necessarily mean that the pricing has changed, as the expectation of pricing seems to be mapping to the public markets more than it is to what those of us would look at as the normal for multiples. And in some instances, that has also meant that there are certain managers that we decided we weren't going to pursue actively because we didn't like how they were calculating their pricing and paying 11 times on a deal that we thought looked better at a 7. And their argument was, well, we can get all this debt at very attractive terms. And then I asked the question, in 3 to 5 years, which is your exit period, are those terms going to be available to your purchaser? And what is that going to mean to the price to the price of that deal? So I'm a little concerned about the fluff, that shall we say, in some of those pricing. And the venture side, there's an awful lot more deals, The pricing there is extraordinary. There are some realistic ones, but I guess I'm at the stage now, particularly with SPACs, that I get nosebleed every time I look at those. And I don't believe that that's going to end well. I particularly don't believe that it's going to end well with all the individual investors that are piling in. I think we saw some of the results of that with Robinhood, and be interesting to see how that is all going to turn out, because if people are going to go back to work and not just be playing at investing, we'll see what happens in that world. But there, having said that, there's still a hell of a lot of innovation going on. There's a tremendous amount of innovation, both on IT and computers and cybersecurity and biotech. A lot of those industries, as Mr. Welsh predicted, and unfortunately his prediction came to pass with GE. There is a huge amount of innovation going on, and people have to latch onto it.
Yeah, I think, Brandon, just to add a little bit to that, we're seeing quite a bit of activity on the fund side. So there's a lot of funds in market, and I think a lot of people are raising funds, because last year was an abysmal year for them. It was hard to raise funds, and so you see there's a little bit of a lagging effect, and I think you see a little bit of the same on the deal side. To comment a little bit more on the tax that David brought up, I think it's a really interesting subject, but it's not the first time this has come up. It's probably in my 20 years of investment career the 5th time that we see a host of deals, because the tax rates are going to change. And what people seem to underestimate is that, or the sellers seem to underestimate, is that companies either ready for a sale or not. And the fact that the tax is going to change doesn't make your company a better candidate for a sales process. You may believe that you should be ahead of that process, but that's not necessarily the way to maximize value. And I think also that goes to the private equity funds that are selling right now. Are you better off taking a higher tax rate on a much better outcome? Or are you better off trying to front run the tax legislation that may be coming down the pike? But we're seeing a ton of activity in the market, and it's an interesting market, because it's a very challenging market to invest in. Because if you look at the market, everybody will tell you that everything that's underperforming or not performing great was impacted by COVID and by a global pandemic. And everything that's outperforming or performing very well was because the managers were excellent at their job and they created these fantastic companies. And so that's a whole different new dynamic we're going to have to deal with as LPs and investors. What is attributable to what? Is it really the manager that generated value? Is it truly the pandemic that held companies back? In certain industries, that's probably easy to figure out, but in a lot of industries, that's going to be a really fun new challenge on the investment side.
Yeah, I mean, from what we see at Hamilton Robinson, I can confirm both Heis, what you said, and David, what you said, that the trend line on volume for us is really 2x above normal, I would say. But it's a mix of both tax motivated selling, but also what I'll call companies prematurely coming to market, where you had some sort of COVID impact on the performance in 2020. You've had a rebound in 21. They're building forecasts and pro formas off of that higher, 2021 performance. They're sort of adjusting the 2020 performance so that there's a nice smooth trend line. But as an investor, we're sitting here saying, well, is that really going to continue, right? So I think we're seeing lots of volume, at least from the deal point of view, but it's a little bit mixed as to really what's driving it, whether it's tax or other considerations.
So let me see if I can actually throw something at the moderator. So I think one of your strategies is that you don't necessarily take out the founder or owners totally, but you keep them, rolling some percentage into the deal. Has the attitude towards that rollover changed with their anticipation of tax differentials?
Believe it or not, David, I was on a call earlier today with a business owner who asked if they could, we'd structured a transaction to provide for a tax deferred rollover for the seller. And they actually asked if they could pay their taxes now and then roll over on an after-tax basis. It's the first time that I've ever had that happen to me. But it's obviously situationally dependent, but certainly sellers are thinking about it. I think they're thinking more about sort of the tax structuring of it and less about the magnitude of the rollover. I think that appetite and sort of, it's such a fundamental requirement for us in our investment process that it's been unimpacted from the tax changes. Paul, are you seeing anything different from your perspective relative to deal flow or potential impacts from taxes?
So we certainly do see that it continues to be a bit of a seller's market. There's a lot of money out there, and we continue to respect people like yourself that continue to do controlled investments, and perhaps are not kind of doing the shift toward growth investing and tech and fintech kinds of investing and other things that have helped some other firms maintain some of their return profile. And so we certainly think that in the long term private equity is supposed to be about control, and it's supposed to be about some leverage and working with really Main Street rather than a lot of these high-flying tech stocks and everything else. And so we do appreciate that, and we continue to support that. But in general, we are seeing a lot of deal flow. We are looking at some distressed situations, and we have to admit, we don't think the buyers and sellers these days agree on what the valuation should be. And so we're probably going to wait another 3 to 6 months to see if sellers on at least distressed situations will we think come to some reasonable levels.
Yeah, and I also think as the year progresses and these tax changes become more clear to everybody, because right now we're all guessing a little bit. We know something is coming. Desperation at some sellers will start setting in more, and that may actually, to David's point earlier, that may actually change the pricing on some of these companies. And it's not the first time we would have seen that, where you get the Q4 discount on the company because the seller wants to get it done, as long as the team is willing to sign before December 31st.
Right. Kevin, do we have any questions from the audience?
We do, thank you. I was just going to point out, we have a little over 10 minutes left. So if you have other questions, or if you want to address some of those tax issues, I know you touched on that in your presentation, and you have some unique guidance around that, but you may want to work in a couple of the questions on the box. One of them being most recently, actually a new one just popped up, but how are you factoring COVID economic stimulus and financing forbearance phase outs into your thinking?
Anyone want to jump in?
I can. I mean, I think it's the overall question on that we touched on. I think stimulus was extremely helpful to a lot of these companies. I think a lot of these companies had a very nice balance sheet lift because of it in the end. But let's also not forget that there were a lot of companies out there that actually really needed it to stay the course throughout the whole pandemic. I think at its core, it goes to what I was saying before, and it's going to be much harder from a due diligence point of view to figure out why and how companies have truly performed throughout the pandemic, and what were the actual forces at work here. And this is just one of those other variables that makes it even more difficult to figure out what was really going on in these businesses. And I think it will lead to, from our perspective at least, more hesitance in underwriting companies and teams, because we'll really want to figure out what the basis for all of it is.
I agree with you, Heis, completely. The point I was making about companies coming to market prematurely, I mean, that's really our knee-jerk sort of reaction, or the way that we internalize, the uncertainty around what's driving performance. It's in our business, looking at individual companies and deals, buying off of a spike, whether that's stimulus driven, whether that's market driven, for any reason. That's sort of the biggest part of getting your head or getting your arms around a performance of a company, and how that translates into deal structure and value, and your level of aggression on a deal. So it's a tough thing to handicap, and I think until we have a little bit more history to judge, I don't think that we're going to have really a full picture on many of these businesses.
Yeah, if I can mention, that from our perspective, as an LP, we have to admit that's the process we're going through, is talking to our GPs and asking them, how they feel about, what's happening and when the transition will be, and how that impacts their process. Because certainly, a litmus test for a lot of GPs was, of course, how they got through the Great Recession, 10, 15 years ago. And perhaps before that, the whole internet bubble and things. And so, this is certainly another crisis that, GPs had to go through. And, we really respect those that are able to, get through this and get through this well. And I think, that will certainly speak to, our future involvement, as well as hopefully the ones that will really be successful going forward. So, I think it is important to really, talk to your GPs and learn from them and see how that will go.
Speaking of learning from our GPs, Brandon, I touched on the tax issue, and another question came up along those lines with concern around changes in capital gains tax increases. Are any of these next generation sellers looking at opportunity zone funds to defer capital gains, and you have a different way of approaching that, Brandon? But one of the good problems that we have, and I'm combining another question in here about inflation levels affecting multiples, is that deals are being exited, distributions are coming out. That's a good problem to have, but how are people dealing with that? So Brandon, any comments around inflated deal prices, and also capital gains tax increases and so on?
Yeah, I think on the tax side, we've kind of covered, there's certainly tax motivated selling from family owners who don't have a succession plan kind of in place in their business. From a inflation and from a pricing point of view, it gets back to sort of this uncertainty with in many of our businesses that have significant raw material inputs, whether that's plastic resin, whether that's wood, whether that's metals. That creates opportunities for good management teams to get in front of pricing and create margin opportunities for their business amid fluctuations and commodity costs. That oftentimes has a direct bottom line impact on many of these businesses. And to my point before, untangling what's driving a surge in performance in businesses is, that's really the game here. And it can be market driven, it can be stimulus driven, it can be commodity driven, and unwinding all of that and sort of normalizing is the key to making good investment decisions. So I don't think it has a direct impact on pricing of deals, but it's certainly an element of diligence that you've got to get your arms around in any particular situation. And then finally on your point on taxes, we take advantage of Section 1202, which I mentioned in my section before. This is an attractive attribute for many family owners who are looking to reinvest into a business. There is one of the key criteria to achieving the qualification for 1202 is a 5-year hold period. So it's a little bit ambiguous, and we never promise our family sellers that we will hold a business for 5 years to qualify for it. But the opportunity to potentially defer taxes on a rollover and then eventually eliminate the gains after 5 years of additional hold is a really attractive, feature for a lot of family sellers, and certainly is worked pretty prominently into our pitch to those family business owners.
Yeah, I'd like to add something on the capital gain tax changes, and also the changes that already happened last year, because as an investor, a whole new level of conflict has arisen now that capital gains are taxed differently for the GPs over periods of time, and where we were always eager to get long-term capital gains for your limited partners. That long-term capital gain for the GP doesn't set in unless something is held at least 3 years. And so there's a whole new level of conflict that has arisen in these partnerships, because a lot of decisions get made, or there is a discrepancy between the LP and the GP on capital gains tax at this point, which is an interesting new dynamic. And taxes should be part of the equation. But if they start driving the equation, weird things start happening. So we're keeping a very close eye on that. And we think it's an interesting but often overlooked part of what's going on in the tax code at the moment.
I think the taxes clearly have an impact on the behavior. I'm probably more concerned about what I see as the excess liquidity in the marketplace than I am about the taxes. And what I'm looking for from our managers is, are they really maintaining discipline, or are they rushing to follow the crowd? Because momentum investing works until it doesn't. And when it doesn't, it's pretty disastrous. And if anybody forgets about 2008, should go back and reread it. I see some risks in the current environment that are very similar to 2007. And I had some managers that actually didn't invest at all in 2007. And that caused some real discussions with the LPs at the annual meeting. But when I was talking to them and they were saying, well, everybody else is paying 10x and we still think that they're worth 6x, I was happy with them. And the ultimate return on those funds turned out to be better than several of the others.
Hey, David, that's a great segue. So as we wrap up here, I was going to ask each of you kind of what trends or general ideas sort of keep you up at night, sleepless, obviously concerns. In your situation, how do you help mitigate or compensate for something like that? I mean, is it just proactive communication with your managers, or are you changing the way that you go through your selection process or your diligence process for managers? How do you compensate for that?
Well, like I said, we like to see managers being disciplined, and in our parlance, which means not following the crowd, but having a rationale. And the reason that we're investing in private equity is because it's a longer term invest, and we're expecting some payment for tying up our money for that period of time, as opposed to trading in and out of the market. So I want to hear a rationale for why they're paying the prices that they are. Sometimes I can be convinced, but I would say that that's not the majority of times. Well, in particular marketplaces, if they can show me, or I don't know, you can't show the future, you can talk about why you think a thing, and maybe I can be convinced that you should be paying a little bit more because of a long-term trend that you have some basis to believe in. But in general, we still are believers that there is a tendency to revert to the mean. And so I need to be convinced that there's a reason that it's not going to not just return to the mean, but sometimes bounce through it.
Right. That's great. Paul, how about you? Anything that keeps you up at night?
Yeah, I think that we sometimes have a natural tendency to think a little bit differently when it's our money versus, when you sit on a board of an endowment or something. We probably think a little differently, because in endowment, we're kind of, we have investment policies, and we're investing especially in, let's say, equity funds that are paid to be, fully invested all the time. And it always boggles my mind that these equity managers can sleep well every night, because things can happen, and they're out there, they're fully invested, and we think that can be kind of risky. So if it's my money, I'm not sure that I would do that. And so we certainly have shifted with a lot of others into more private market investing, and we actually tell our GPs, look, we understand there's discipline and there's focus and all those types of things, but in unusual situations, you guys need to do what it takes to make sure we don't lose money and other things. And so we accept that some fund managers will kind of stray from perhaps their core investment style in unusual situations. And especially if it's our money, we think that that's often justified, and we applaud GPs who are able to do that and get us through crises, and we think that that's an important consideration.
For sure. Ice, you want to bring us home? What keeps you up at night?
Hopefully not too much, but the thing that really keeps me up more is not what we did yesterday, but what are we going to do tomorrow? Because we don't know what you don't know, and that applies to everything in our business. It's in diligence on the funds, it's in diligence on companies. You're dealing with very smart people on all sides of the table. The information is extremely well curated, and so you have to just be very much seller be aware. You don't know everything, and trying to figure everything out is what keeps me up at night. So random questions about deals and funds and teams and markets, that's what pops into my mind, and that's what might keep me up at night. I hope not all the time, but that's what we'll do it.
Well, Jack Welch had it right. You've got to keep the change of pace going and keep the questions going, right?
Well, curiosity is a great driver of good returns. That's for sure.
There you go.
Well, that does tie in well and wraps up our time. But it reminds me of your quote that you cited there, Heis, and Jack again had said that change on the outside can be greater than that on the inside. And it sounds like the overall processes that we're hearing from our investors have stayed very much the same, relying on process and people. And going back to your quote, Brandon, the future ain't what it used to be. So we've got to watch that change and see how we're going to adapt. Paul, I'm noting that you said power corrupts. Absolute power corrupts absolutely, and that's what's tricky in these times, is that we're not sure where the change is going to come from with people making very impactful decisions, and all of you as investors need to consider that, and it's very challenging, since, as David said from Socrates, know yourself, and that means knowing those managers, knowing everyone in our community, which brings us exactly to where I had hoped to be at the end of this, which is realizing that we all need each other. It takes a village. This is a community. And so for that, all of the speakers, I'd like to thank you very much for making time. Obviously, you could be on 10 different investment calls right now, since everyone's combining Zoom with their private meeting, their in-person meetings and so on. And thank all of you for listening in. For those on the box, our next webinar will be November 3rd. We'll be discussing a range of topics in private markets, and I'm actually open to input on what those topics will be. Again, it's a community. I like to hear what people are thinking about before we set the agenda. You can sign up using links that I'll be sending out to all of you, and we'll be announcing more details, as well as a live private markets insider summit that I'm planning right now for December. Now, a lot of things are up in the air, so that may be pushed to January. Again, I'll be looking for input, and I'll be talking with some of you directly, but we're open to speakers and topics and making plans. So as a final reminder, Private Markets Insider is a platform for identifying investors, funds, and deals through relevant content like this in our community. So feel free to reach out and chat about what you're seeing, what you'd like to see, and I may follow up with some of you to discuss deals and funds that would seem to fit your interests, and I can do a better job and not pester you if I know exactly what your interests are. So that's part of the reason for some of my outreach. And meanwhile, I sincerely hope that you capture these last few days of summer, and depending on what how your calendar is, summer isn't over yet. So enjoy, and thank you, everyone.